Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Thomas. It's fantastic to have you on the podcast show.
Thanks a lot, Bilal. It's great to be on.
Great. Now, I got a lot to talk to you about in terms of your research. But before we do that, I do like to know something about the origin story of my guests. And so it would be great to hear in your own words what you studied at university, and was it inevitable you'd end up in academia and in economics?
Yeah, I grew up in Germany, went to high school there, and then studied economics in college at Goethe University in Frankfurt. That was a great place to study and a great time. I started in 2006. So in the middle of my college days is when the great financial crisis happened. And it was in Frankfurt where the ECB is, the Bundesbank is. So I think that really shaped my interest early on in macroeconomics, finance, central banking, and so on. I then did a master's in MHC at UCL in London. Really liked that as well. And during that time, got very interested in the idea of doing a PhD. So after that MSc, I worked for 1 year at the ECB. So went back to Frankfurt from London, worked at the ECB in the research department, which was also very, very interesting. That was then the time of the Euro crisis, the European sovereign debt crisis. So again, a very interesting time. And during that year, I applied to grad school and then went on to do a PhD at LSE, which was also a fantastic experience. I had great advisors there, great classmates, and when finishing the PhD, went on.
And out of interest, what was your PhD on?
So it was on macroeconomics. My thesis was very focused on the role of credit frictions in the macroeconomy, and in particular, how corporations borrow, what their contracts look like specifically. So I brought in some microeconomic detail on corporate debt contracts, and then looked at how that affects macroeconomic fluctuations, basically. That was what my thesis was on. And then I went on the academic job market, applied kind of all around the world for academic jobs, and then ended up in the US. I'm now an assistant professor at the University of Maryland. It's been 5 years. It's very nice here. Our campus is really beautiful. We're very close to DC. I also live in DC. So I'm again in a place where, the Fed, the IMF, the World Bank, and so on are nearby. And I really, really like that.
That's great. It sounds like you're advertising Maryland University as well there, in terms of the campus and the location. So that's good to hear.
Yes.
Now, you've been writing some really great papers recently, and one that really stood out for me was a paper that you published recently, at least I think it's a working paper, on how to measure the effects of political pressure on the Fed. In the markets, lots of people have theories about how politicians influence the Fed. There's conspiracy theories as well around all of this. And I think you've looked at this in a much more rigorous fashion. So it'd be great to hear how you went about trying to look at this question more rigorously.
Sure, yeah. In that paper, I study what happens to the US economy when US presidents exert political pressure on the Fed. And I do that with a new data set that I collected from archival records and with a new identification strategy. I'll tell you about that kind of in more detail, but the headline finding I have is that pressure that presidents exert on the Fed is strongly inflationary, and it in particular operates through inflation expectations. But let me unpack all of that a little bit more. First, perhaps let me take a small step back and say this work is motivated by a growing concern that there's political pressure on the Fed. In the US, that wasn't a big topic for many years. Most presidents respected the independence. In other emerging economies, think of Turkey and so on, that was more on the agenda. So in the US, it's a big topic again. Studying it is actually pretty difficult because political pressure is such a fluffy concept. You know, it's such a hard to define notion. So it's important to have a definition, have measurement, and so forth. So that there isn't that much there. We have a good kind of directional idea about that. That can be a bad thing, but I try to bring in better measurement, better data, and so on. So the two elements of what I do is the new data and the identification. Let me tell you about both of them. So the new data is a little bit out of the box data. It's not quite economic data, but what I did is I thought, well, how can we have an empirical measure that might reflect political pressure that we have consistently through time that can span multiple presidents, multiple decades? So what I did is I just looked at how often presidents met with Fed officials. The nice thing is that's easily possible in the US because we have for many, many decades the daily calendars of US presidents that are available through the so-called presidential libraries. So these are archival records, and we can look for every president, what they did every day, every hour. And we have that. The format is actually surprisingly similar over a long time period. It starts with Franklin D. Roosevelt and ends with Barack Obama. I don't have those schedules yet for the first Trump presidency and for Biden, but from Roosevelt to Obama, I basically
and
went
just
through
on
all
that. Is the data published with a lag? Is that why you don't have Trump's administration?
Yes.
Okay.
That's right. Basically, after a presidency, each president gets a presidential library that gets built. There's some fundraising involved and so on. And then the documents from the presidency get stored in that library and researchers can access that. And the Trump presidential library is, I think, in the making, but it doesn't exist yet. And, you know, there are also these issues with him not giving back certain documents from the presidency and so on. That's all, I think, you know, even if that library at some point gets built, I don't know how that will all play out with the Trump presidency, but that's perhaps another story. So I went through all of those calendars, and it's in the paper, I have some examples of the calendars, and for some presidents, it's really easy to find them online. Your listeners can just sort of Google that and look it up. For other presidents, it's more difficult and you need to access them on site. But I went over all of them and collected every meeting that each president had with anybody from the Federal Reserve. And then sort of built a database with those meetings. And I can use that to construct time series of the meeting frequency over many decades. And
in terms of the calendar, are there also minutes of the meeting as well? Do we know what they talked about in the meetings?
We don't. So those calendars just give us the meetings, what time, how long, who else was in the room. They don't tell us what was discussed. That's important. I'll come back much more to that. For some presidents, we have other sources. In particular, for Nixon, we have the Nixon tapes where, you know, he actually taped what was said, and we can connect that. But for most presidents, we don't know what was said. That's important because while those meetings are interesting to see that meeting frequency, it's not necessarily political pressure. I started off by saying I want to measure political pressure. The meetings themselves are not necessarily pressure. I'll tell you a little bit about just the meetings as raw data, but then I'll get to how I try to elicit information about pressure from them. So if you just look at the raw meetings, and again, they could be about many things, you already see that the variation is very significant. So if you look at the 1990s and the 2000s, there are very few interactions. Say Bill Clinton, in 8 years as president, met with Fed officials only 6 times. And those were typically say, a swearing-in ceremony of a new
6 in total
member
of 8 years.
Yes,
Not 6 per year, so 6 in total.
No, 6 in total. 6 in total over 8 years. Those were typically swearing-in ceremonies and official, official sort of appointments. If you look at the 60s and the 70s, things look very different. And in particular, the president with most meetings was Richard Nixon. He was president for 5.5 years because his second presidency ended in the middle. And he met in 5.5 years 160 times with Fed officials.
Okay, so that's an order of magnitude difference there.
Exactly. There's one period which I'm going to talk about a little more, which is when he basically met more than weekly with the Fed chair, Arthur Burns. It was a very different world back then. And we also know that the 60s and the 70s saw very high inflation in those decades. So there might be a connection here, but actually it could all be reverse causality. It could just be we had high inflation back then for whatever reason. And that's why President and Fed chair talked about it, maybe to solve that problem, or the president just wanted updates from the Fed chair. So again, not clear that this is pressure. It's still a pretty interesting account of history to see how this meeting frequency changes through time. But then I want to do more. So I'll talk about the identification approach that I have. Basically, my idea is the following. This meeting time series might reflect pressure in some periods. In others, it might not reflect pressure. And in general, this meeting time series can respond to other economic variables. So what I do is I use a vector autoregression approach, which is an economic approach in macroeconomics, with which we can try to isolate changes in the macroeconomy that are quote unquote exogenous, where the causality goes in one direction. So these techniques have been applied to fiscal policy, monetary policy, other kind of big changes in the macroeconomy where you have a similar identification problem. We see fiscal spending changes over time, but that could all be a consequence of what happens in the economy. So I use such an approach. And what I then do is I tell this econometric model, essentially, I put a restriction on that model and I say, I'm going to point to some specific quarters in this long sample. And in these quarters, I'm going to impose that the meeting variation is driven by a political pressure shock, which is something that I define as something that happens not in response to economic conditions, but for political reason, and something that increases the meetings and eases monetary policy. And then I tell the VAR about two periods in particular. One is the Nixon period, and the other one is the Lyndon B. Johnson period. In both of those presidencies, there were particular times when we know from historical accounts that these presidents did exert pressure on the Fed, and it arguably had an effect. So for Nixon, that was prior to his re-election. The second Nixon election was in 1972. And in 1971, Nixon got very obsessed with being re-elected. We know he did all sorts of things to be re-elected. There was the Watergate scandal and so on. During that period, he also very explicitly put pressure on Arthur Burns to ease monetary policy. And we know that from the Nixon tapes that I mentioned earlier. We have other accounts, for example, the diary of Arthur Burns. He wrote a personal diary that was published many years later where he describes conversations with Nixon. And it's very clear he very explicitly said, look, I want you to ease monetary policy. I want the economy to be stimulated because I want to be in the White House again. Literally, that's very explicitly what he said. And Burns, whether he reacted to that, that's a little more contested. In the paper, I have some corroborating evidence for that as well. But to be fair, it's a bit a debate among historians whether you can say that he reacted. Because of course he didn't go back to the FOMC and he said, look, guys, Nixon told me we better ease monetary conditions. Let's do it. He didn't do it that way. But my reading of the evidence is that he did cave. He did give in to the pressure because we saw a very large monetary easing in 1971 that is very difficult to explain with economic conditions at the time. And then right after the 1972 election, they tightened really drastically. So, I mean, looking at that, my sense is that Burns gave in. So that basically this episode, I use his, historical narrative to translate that into an econometric restriction on an econometric model.
And so by introducing episodes where there was political pressure, it then improves the model, you're saying?
Correct.
Yeah.
It allows the model basically to then, because in the model, at the onset, when I include all the data, everything is allowed to depend on everything. So you need additional restrictions on the model to be able to draw inference about effects that go in one or the other direction. That's the idea. And those restrictions, I draw them by imposing that in certain periods, I say I basically know that the direction went one way.
Political pressure to the economy. Yeah.
That's right. That's the idea. That's that technique for your listeners who might be interested in the more technical aspect. It's called narrative sign restrictions. That's based on a paper by Antolin Diaz and Rubio Ramirez. It's a very interesting technique. So I didn't invent that technique. I apply it to this political pressure environment. And then, so for Johnson, there was also this episode where he put pressure on William McChesney Martin. That one is even a little bit less clear than the Burns episode. But in the paper, I used both of those episodes. Actually, the Nixon episode is already enough to get some good sharp inference from this technique. But Johnson is also interesting. I mean, there's one account where he literally physically attacked the Fed chair. So he invited him to his ranch. He was from Texas, LBJ. He invited the Fed chair to his ranch and kind of shoved him against the wall and said, I want you to ease. Yeah.
The old days were just different from today.
Yeah. Yes. Okay, so what do I find then? Let me tell you a bit about the results. So I have this econometric model. I use this new data and then these restrictions. And then what the model gives me is basically, I have this impulse in the model. I have this shock, this political pressure shock to the system. And then I have all sorts of macro data in this model, and I can see how the macro data then dynamically responds to that shock. And what I find is that we see a gradual increase in the price level in inflation. So I should say these responses that I'm going to now describe, these are kind of the way to interpret that is that's over and above what happens if that shock hadn't happened. So of course the price level always grows, but we sort of think of that, we hold that trend constant, and then over and above the extra effect that we get from political pressure. And you get this extra boost in the price level. So you get an increase in inflation. And that is kind of slow, but very persistent. So over the following 10 years, you see this effect. And you see that I can also quantify that effect. I have this quantification where I say, if you have pressure, political pressure that has half of the intensity of Nixon's pressure, and I can make that statement because I have an intensity measure from those meetings. If you have half of that intensity for a 6 months period, then the price level over the following 10 years goes up by 8%. That's an economically, that's an economically pretty large effect. And what I also find is that at the same time, basically nothing happens to real economic activity. And that's very interesting and also a little puzzling. After all, Nixon wanted stimulus. He wanted real activity to be stimulated to make voters happy. But what we get from the pressure is basically only an inflationary effect. And how can that be? Because we also know that in general, from these type of econometric approaches, we know in general, when there is an easing, a monetary easing, we see more inflation and more output. So what I then show in the paper is that you actually get a very strong response of inflation expectations. It's basically the case that the public understands that this monetary easing is somehow different. The public understands either it's financial market participants, households, firms. I can't yet pin it down.
But how are you measuring inflation expectations? Because presumably you have that as a factor.
Yeah, I use the Livingston survey of inflation expectations. So that's a measure of professional economists forecasting inflation, and those really adjust their inflation expectations upwards. So the market understands the pressure, and in some way this means you get some kind of inflationary bias. We know that also from theoretical work in macroeconomics. If kind of rational agents understand we now have a policymaker and the objective of the policymaker is different, the objective is they want to run the economy hot, the consequence can be that you actually, prices jump up, but activity doesn't. So this also consistent with macroeconomic theory. And that's what I find here. So there is an inflationary effect. It operates through inflation expectations, and there isn't stimulus in real activity. Of course, one thing I can't exclude, and that's also something I want to understand a little bit better still. It could be that certain types of activity were stimulated more at the micro level, and maybe that made Nixon voters happy. Maybe I could look at in more detail at geographic effects, say in the housing market. Somewhere there was probably stimulus, but in the aggregate, you don't get a boost to real GDP.
And then if you kind of move the model forward to today, you said earlier that because of lags in the data, we don't have data for Trump and Biden. But is there a way of coming up with a proxy for political pressure, do you think?
Potentially, yes. It's difficult. We have to be careful with using those numbers and applying them today. But let me talk a little bit about that. So one thing that makes it difficult is in the episodes that I use, the pressure and the way I define this shock, the pressure is successful. So the way to interpret my numbers, and I do have a quantification that we could potentially apply in real time, but the way to read them is that's pressure that is successful. Now, many people have asked me, what about Trump? What about the first Trump presidency? So when Trump was president, he very actively pressured the Fed through Twitter and public interviews and so on. Now, during that period, my interpretation of what happened is that the Fed stayed strong, stayed firm, and they didn't give in to the pressure. What's interesting during that period is there is some Another interesting paper by Francesco Bianchi and collaborators. He's a professor at Johns Hopkins University. They looked at the effect of Trump's tweets on the Fed using a high frequency approach, and they find that markets did price in to some degree that there might be an easing when Trump says, the Fed should ease. But that's sort of the probability was adjusted, but it didn't completely move the expectations to firmly expecting an easing. And an easing, I think, didn't happen. So for that episode, it's limited in how we can apply my numbers to that episode. But there we have this nice paper by Francesco. Now, let's look to the next presidency. We don't know who'll be in the White House. I think in general, there's always temptation to pressure the Fed. Also, we have very high debt levels. I think any president, Democrat or Republican, might have the temptation. But we do know one of the candidates, Trump, again, has been quite explicit in saying he's gonna weigh in on the decisions and so on. So should we get a Trump presidency, and should he do that? And should we see the Fed to some degree react? Then I think we can try to make some sort of interpolation, I think.
Absolutely.
But I would need to look at
the other question I had was, if you look at, say, the Biden administration, there could also be political pressure, but in a more subtle way, because you have Janet Yellen, who's a Treasury Secretary. You have Lael Brainard, who's one of the senior economic advisors to Biden. And she was previously the vice chair of the Fed. So through appointments in the government, you could actually have very influential characters who could gang up on Powell. Because Brainard and Yellen in particular is much more of a heavyweight in terms of monetary policy. So behind the scenes, they could be pressuring Powell and others at the Fed.
Absolutely. I completely agree with that. And that could have also gone on in history at many different points. That's something I don't measure. And that's something in my paper that I might be missing. I agree with that. There are many channels through which pressure can happen. I have one channel where I have data on it, and I have the strategy, and I can estimate effects of that, but there might be others that I don't.
But also, capture. I guess in your work, you also found a shift in inflation expectations. So that could also be something one could start to monitor. So monitor kind of like public pressure, like tweets and such, and then also look at how inflation expectations are moving around those events. And then you could kind of decipher how that's affecting things.
Correct. Yes.
Okay, that's great. Now, fantastic work, and I think we in our research team, we're going to start to see if we can come up with the real-time proxies for that. So you've inspired our research agenda. The other paper I found that was really interesting that you published was a paper on monetary policy shocks. And so the idea here is that if you look at Fed forecasts, the actual statistical forecasts, and from that, you kind of back out what the Fed would do or should do. You end up finding historically that the Fed often ends up doing much more or much less than what their forecast would have suggested. And so you have this kind of unexplained shock. And, there's been some academic work. You cited Roma and Roma, which is the sort of the classic piece on this. And you've come up with some work to say, actually, it's not as much of a shock as we think it is, because we aren't looking at a complete data set.
That's correct. Yeah, in that paper, the goal is to assess the effects of a change in monetary policy, but also monetary policy reacts to economic conditions. Just like I was describing in the previous paper, there's an identification issue when we think about monetary policy. We could look at the recent interest rate decision and then just say, okay, after this decision, what happens to macroeconomic variables? But the Fed made that decision because macroeconomic variables are moving in a certain way. So what researchers have done is they have tried to basically use economic data to predict a Fed decision. and then look at how the actual decision deviates from the predicted decision. And that deviation might just be, 5 basis points or something. That might not always be a full notch, but you might say that some portion cannot be predicted based on economic data. And then that is called a monetary policy shock. And then that can be used in regressions and so on to look at how monetary policy affects macroeconomic variables, because arguably that shock is not an endogenous, systematic response to other macro variables. And you mentioned this Roma and Roma paper that has been a very influential paper in doing that, in applying that technique. They kind of came up with that whole idea. It's very influential. And what they did is they said, let's look at the Fed green books. Nowadays, they're called the teal books, which are documents that the Fed staff, the staff economists, put together and they give to the FOMC. And then the FOMC reads those and makes their decisions. And in those documents, there are forecasts. And these forecasts we know are very good forecasts. Also, I work also a bit on forecasting. The Fed has pretty good forecasters. Now, so basically what the Roma said is, let's take interest rate decisions and let's regress them on these forecasts from the Green Book, so that regression basically captures the systematic part. And then you get a residual, the unexplained interest rate variation, not explained by the forecast. And let's call that a monetary policy shock. Very influential paper. Now, what we are saying in this paper, and this is with my University of Maryland colleague, Boran Aruoba, what we say is, look, they look not only at forecasts, they look at a lot of information. And in particular, in that green book, nowadays the teal book, there is lots of textual information. The staff economists carefully craft a text where they describe economic conditions, they describe financial market developments, housing market developments, prices at the micro level, international developments, etc., etc., etc. So all that information might be relevant to predict interest rate decisions, might be relevant to capture the systematic component of policy.
And the important point here is that this green book or teal book is used by all the Fed FOMC members. So they're consuming this report, and then this is the information set. So it's both the forecast, the data forecast, the statistical forecast, and this textual data. So intuitively, it makes sense. You need to look at the complete information set that they're digesting.
Exactly. That's exactly right. And since a lot of that information is textual information, what we do is we apply natural language processing and machine learning techniques to then take the text from the Green Book and predict interest rate decisions using the text. So we use some kind of new techniques in this space, and then do what was done in the Roma and Roma paper, but instead of using numerical forecasts to predict interest rate decisions, we use language. And what we find is that this really helps in predicting interest rate decisions. And this basically, our techniques imply that the systematic component of policy explains a much larger share of actual policy. So the monetary policy shocks that we back out, they are much less important. They are much smaller, which is, in some sense, that is appealing, because most people think, a lot, if not all, of the variation in the target federal funds rate is probably desired by the Fed, and at a given point,
it kind of makes sense. I mean, it should generally be fairly rational and everything, and shouldn't be kind of random or something like that.
Exactly.
Now, when you say prediction, does that imply if we had that Green Book information, we could predict the Fed policy rate going forward, and it could potentially be used by investors?
Potentially, yes. I think many investors would be pretty keen to have the teal book in real time. I think so. I think that could potentially be used. One caveat is when I say prediction, my statement is not about true out of sample prediction. I basically talk about in-sample prediction. That's a little subtle.
Okay, understood.
But I'm not interested in having a true out-of-sample forecasting model here. I mean, I do that too. I'm interested in those techniques as well, but I don't need that here because here I just want to fit in sample
Yeah,
the
you just want to try
decisions.
to understand how can you explain the in-sample dynamics. Now, on the
Correct.
green book or teal book, it comes out with a lag as usual with all the good
Yep.
stuff. Everything comes with a lag. How much of a lag is there with the green book?
5 years.
5 years. Okay.
There's a 5-year lag. That makes it, in real time for people in financial markets, that makes it pretty useless. What is available in real time is the beige book.
Yeah.
The beige book is similar to the green book. It's something that economists at the regional reserve banks prepare. And we also have an application in the paper where we use the beige books and we try to go to the very end of the sample. Currently, we have to stop in 2018, I think, because of this 5-year lag, but you can use the beige book that comes out in real time before every FOMC member, though I think it comes out usually 10 days or something like that before. That also has the issue then sometimes there are data releases after the beige book comes out. So using just the beige book in real time is then also problematic, but we have applied our techniques to that. And we find that the information in the beige book has some relevance, gives you some predictive power for those decisions.
And actually, we've done some work on the beige book, and we've created an index as well based on the beige book. But another thing we've done is we've looked at Fed speeches and minutes and turned that into an index. So I'm wondering whether that could be useful for your work. We go back 10, 15 years.
Yes.
We just launched that, released that index very recently, and we use fairly advanced techniques. We use the fine-tuned LLM model to basically extract the sentiment from that.
Yeah. That's a great idea to do, and there's lots of work in this space. I think in academia and in markets, there's so much attention now to communication by the Fed, to speeches by the chair, and so on. And that's, it's very useful to apply language techniques also to that. We don't do that in this paper just because we want to have this measure of monetary policy shocks over a longer sample. And back in the days that these speeches just weren't as much a thing as they are today. I mean, the Fed has kind of moved to a model now where they talk rates up and down and expectations kind of in between meetings, and they really try to steer the expectation. It's a very different model. That might also mean this measure of monetary policy shocks nowadays, we should kind of rethink about them entirely. But in general, I think there's lots of promise in using these techniques, and speeches are also a good place to look.
Absolutely.
I agree with that.
Now the third paper I thought was interesting that you've worked on is a paper on nowcasting economic activity. And you have a slightly different approach to what many people do. So if you could talk about that'd be great. I mean, nowcasting is very popular amongst investors. So first of all, I mean, what are the sort of standard model, as you call it? And then you can talk about the extensions that you do.
Absolutely. This is work that I do with my friends and long-term co-authors, Juan Antolin Diaz and Ivan Petrella. And we use dynamic factor models to nowcast economic activity, to nowcast GDP. And many people do that. The idea of a dynamic factor model is that, we are interested in in nowcasting GDP and getting a good understanding of where GDP is right now. But GDP only comes out every quarter and with a big delay. But there's lots of other data about the economy, about activity, say surveys, the PMIs, labor market data, housing market data, and so on. And the idea of a dynamic factor model is that you say, we put all of that data together in a statistical model and we extract a common factor that is kind of the underlying latent driver of the cycle. And since that other data is more frequent and comes out faster, we can then draw inference about where that underlying factor is now and where real GDP
So is that like a principal component analysis, like a PCA approach?
Yes. It's very similar to that. Yeah. So this is an approach that is pretty established, and what our agenda here is in this space is that often when people use these models, they take out certain features of the data by pre-filtering and pre-transforming the data to bring them into this model. So say you take the data in growth rates and you model the mean of the growth rate as a constant mean. Or you take outliers that are in some of those data and you kind of remove manually some outliers because they're problematic for the model. So what we do is we use a Bayesian approach. So we use the statistical techniques that we use are Bayesian estimation techniques for this model. And this allows us to have more parameters and more features in the model. So lots of features of the data that we think are important, like low frequency changes in the mean, changes in the underlying volatility of the data, phase shifts in the data, outliers in the data. A lot of these features of the data are typically treated as nuisance and they are filtered out. And we model those explicitly. We model those with statistical processes in our nowcasting framework. We estimate that with Bayesian techniques, and this gives us a better read of the data. So this is interesting first because we show in our work that this actually helps forecasting out of sample. All of these features that we model explicitly help forecasting out of sample, but also you get a real-time read of some of those features themselves. So you get a real-time read of where is volatility now? Where is the low frequency component of activity now? So where is the trend of activity now? That's very important because if you think about, say, Fed decisions, the Fed thinks very hard about what type of the movements we see in activity are just cyclical and what are more permanent, say, because of better productivity and so on. And our model allows us to extract real-time estimates of these types of components. So I think this is, very useful.
And I noticed in your paper, what you found is that more kind of conventional approaches tend to end up overweighting survey data and discarding hard data because hard data tends to behave in a certain way. But your model actually ends up using hard data almost as much as survey data because it understands the lead lags better and takes into account there is some information there.
That's correct. Yes. One of these features that I listed now are these phase shifts. And basically in a typical dynamic factor model, a lot of weight is given to soft macro data, to survey data. But that is partly because of the dynamics in that data. That data is more coincident with the cycle, whereas some of the hard data is leading or lagging. Say, housing data usually has a lead, labor market data has a lag. if you allow the model to incorporate those phase shifts, it understands that and it extracts a better signal from the hard data. And that ultimately improves the nowcast from this model. And the hard data is also that data that is more prone to outliers, because the survey data is kind of constructed to be in a range. Hard data, there can be measurement problems. There can be, sometimes there is a hurricane, say in the US, and there's some weird blips in some of the hard data. So if you also have this outlier modeling that we have, the phase shifts and the outlier modeling, the hard data is much more valuable for the model, and it ultimately produces better nowcasts.
And then this model, are you publishing it like real time now, or was this like a one-off piece of work?
This was a one-off piece of work. We are looking at it every now and then, but we're not publishing it.
Okay, we'll have to have a conversation outside of this. Maybe we could take it on and start to publish it real time. And that's fantastic. I mean, we've talked a lot about your work, and we could carry on talking, but I did want to round off with a few personal questions. One was you obviously work with a lot of young students, and some of our audience are young students as well. What advice would you give students as they're leaving university to enter the wider world?
Yeah, I mean, of course, I could say things like do what you love, etc. These are typical pieces of advice, and I think they're good advice. Let me say something a little bit more specific, perhaps, but I think it's important. When you're in school, in high school, in college, you have teachers, you have people that teach you something, and they are there to do that. They are hired to do that. And that's good. And you sort of get used to that. When you come out of college and you go to grow more and build a better and better skill set, I think you have to get used to the fact that those people that have the knowledge, that have the expertise, they are not hired to teach you. They are usually very busy people that are experts, that have very, very valuable knowledge. They are usually busy people that apply that knowledge elsewhere, and their knowledge is in very high demand. So at some point, I think when you come out of college, you have to make a bit of a switch and not expect that people teach you something because they are there to do that. You have to somehow get close to those people and make yourself useful for those people, become part of their team, and provide those people with work, with help, with support. That's how ultimately the knowledge gets transferred eventually. I think that's an important mindset switch that I think is good to kind of explicitly think about. Yes, people with good expertise are busy. Make yourself useful. Don't expect them to teach you that because they like it.
Yeah, that's great advice. Now, I do like reading books, so I'd like to always ask my guests something about book recommendations. Are there some books that really influence you over your career, or books recently that you've come across that have you found interesting?
Yeah, let me mention one kind of fun one, which is something that I read as a teenager, and that I think got me really interested in economics. It's a book by a German author, but there is an English translation, and the book is called $1 Trillion. And it's a fictional story about a pizza delivery guy in New York who's of Italian origin, and he finds out that he had ancestors in Italy 600 years ago that had some kind of prophecy of their heir many centuries later would need money to change the world. And then they invested money kind of secretly. And that grew over many centuries. And then the guy all of a sudden inherits $1 trillion because the investment has grown so well, but it was kind of under the radar. It's a totally fictional story. But then the guy inherits $1 trillion and learns that his ancestors thought He needs to change the world. There's some sort of prophecy. And then the story goes on about this guy thinking about, what can I do with this money? How can I change the world? And there's lots of economics in that story, because even with that amount of money, if you give that money out to the world's population, it spreads out pretty quickly. And it's not like the world would be such a different place. Anyway, it's a very fun book. It's called $1 trillion. Also for younger readers. I loved it as a teenager. Now, more recently, I like reading Michael Lewis's books. I think all of them are pretty great. I also like the book Lords of Finance by Liaquat Ahamed. Some listeners might know that. If not, I highly recommend that. And then in terms of kind of more popular economic books, although my work is more on business cycles and short-run policy and so on, I love reading books about growth. And I think two really good ones in the past couple of years are the book by Bob Gordon. I'm blanking on the title now, but it's sort of about the end of growth, and we're running out of ideas.
He's kind of a sort of tech skeptic or something, isn't he?
Exactly. So that book is pretty interesting. And then recently, Brad DeLong has a book about growth. I think it's called, I'm blanking on the title as well.
I'll find the title.
Brad DeLong's recent book on growth is also an excellent read.
Okay,
maybe there was
I'll include
too many
book names on the show notes. Now, finally, if people wanted to follow your work, what's the best way for them to do that?
Yeah, I have a personal website. If you just Google my name, Thomas Drechsel Economics, you can find all my work there. I'm also on LinkedIn and on X. My handle is @td_econ. And yeah, very happy to connect with your listeners.
Great. No, that sounds great. Well, once again, thanks a lot for all of the great work that you're doing, and keep up the good work going forward.
Thanks very much.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.